Okay. Good afternoon, everyone. Let's continue to discuss this paper, The Rise of Finance Companies and the FinTech Lenders in Small Business Lending. This paper actually was done very new, especially the database. This is probably the first one using large amounts of FinTech data to examine the empirical study. So the journal, this paper was published in a top 1 journal, so we can learn something from there. And first of all, you might be interested in knowing why after 2008 global financial crisis, the fintech firms emerge and expand rapidly after the crisis. So what's the reason for this? Have you ever think about that? Okay, anyone answer this? Why this is related to global financial crisis? The lending should belong to bank or financial intermediation. But after financial crisis in 2008, the situation totally changed. What's the reason for that? Have you ever thought deeply? We can go back to this slide. Let me ask you first. Can you guys scan this QR code? But let me know how much percentage have you ever thought this problems? This is a multiple choice. You can pick many answers. Yeah, very good. Yeah, this is a multiple choice. We have almost cover each of the answers except the one. Yeah. Okay. Actually, yeah, all of these answers are very important. Um, Traditional bank, yeah, reduce lending after global financial crisis and creating a credit gap for fintech firms. And fintech firms actually they are corporation. They not bank. They are not bank. So the actually did not face the financial regulation. These are different firms, different type of firms, and digital technology and uh, investor uh, preference change and innovation vacant during the financial crisis hindered the bank innovation. So the technology firms fill this gap. This is a very important dimension for fintech firm emerge. So this paper examined the problem and the question about whether fintech firms and finance firm lenders different from bank in serving small business credit. And again, how fintech lenders expand lending after the global financial crisis when traditional bank retreat, and whether fintech lenders substitute for bank or only compensate each other. The authors use UCC data to examine this angle. They compare the evolution of fintech relative to traditional lenders after the global financial crisis. So the main finding of this paper is fintech lenders' market share in small business credit grew more than 100 times, while bank declined moderately, and risky firms or more collateral constraint firms um, shift toward fintech and finance company after the crisis, who fill the resulting credit gap with more flexible and data-driven lending models. And the third one is the fintech credit expand in counties with larger bank shares declines, suggesting both a fintech and bank substitute to each other rather than um, complementary to each other. And no significant factors in real sector improve. So implying another economic expansion doesn't change much after these lenders switching. So this paper have some contribution on different dimension. On non-bank field and the financial crisis can be another story added on, and also can compare fintech, non-bank, and bank, and also can compare supply side and demand side of the funds change. Provide one of the largest sample of this paper on fintech and in the United States. This is the contribution across a different and diversified field: digital finance, banking finance, non-bank, fintech field, or supply shock and demand shock can also apply and integrate into the paper. There are many data sets this paper employee I listed here for your reference. And from the table, actually this paper have a characteristic. They do not use too many econometric methods. Instead, they're using summary statistic across different type of lenders. So here in table 2, there have a lot of panel that summarize different characteristics. So panel A here, they compare banks and non-bank lenders. Here we can see across the sample period here. You can see the numbers of the total loans for non-bank is significantly larger than bank. The provider switched to a non-bank rather than bank. For the number of lenders who have 100 more loans, bank is also smaller than non-bank. And larger than 150, 500, 1,100. And here we can see non-bank is also larger than bank. And the average numbers of loan, non-bank, also larger than bank. The total loans, non-bank, also larger than bank. So you can see the sample period during this sample period. The non-bank increased significantly and positively compared to bank. Before, all of this may belong to bank, but after that, we can see that non-bank grows faster. So this is a number of loans. If we take a look at the lender's type, which one would you be interested in? So we can see the counts and the average per year. The number from the bank is lower than the number from the non-bank, right? So especially the top 4 bank, like Citibank, Bank of America, and the Chase, and another is Wells Fargo. These top 4 bank actually only cover 4. Very small number compared to those small bank. They have much larger land amounts. But in total, banks' numbers is smaller than non-bank. And FinTech is only belong to non-bank in one firm, one category. So non-bank have a lot of diversified financing company, including investing company, independent finance, captive finance, cooperatives, and many other non-bank. But FinTech is a small portion compared to non-bank. Non-bank covered a lot. So FinTech is a new trend. Actually, they are a technology company, but doing something, digital payment or digital lending, and use a platform they innovated. So FinTech firms emerged during after the global financial crisis. Here, it is not a large number among the non-bank. It's only 20. However, their amounts actually increase significantly compared to the others. They have a larger number, but the amount doesn't change, doesn't have a significant change. And here we can see the growth rate. This is from 2006 to 10. It's a very short time, like 5 years. The sample beginning years into after 5 years. But it covered global financial crisis. So we can see bank decline significantly, right? Global financial crisis. Banks lending origination decline significantly. After that is getting better, but we can focus on the global financial crisis because it declines significantly Instead, it let FinTech have a big chance to overcome. The non-bank declined still. However, FinTech, by contrast, increased significantly until 2016, the sample ending year, 100 more times. So FinTech is new emerging firms among the non-bank. And the non-bank here are old firms. And here is a new one. It grows significantly, positively, and especially like outcount the other financing company in the bank. And here I need you to think about the industry, the borrower industry. And here is the sample statistic about a different kind of bank or non-bank, what kind of borrower the firm covered. So here we can see if the bank covers, most of the bank covered like construction, manufacturing firm, right? Compared to others firms, it's a much larger. So bank covered with a fixed assets collateral firms. So you cover the construction and the manufacturing or mining firms much more compared to the others. And FinTech instead, see what's their borrower type. FinTech covered services, industry, and retail, trade, right? So they have different type of borrower industrial coverage. So if you are services firms, you might prefer to borrow from FinTech. If you are retail trade firms, you might prefer to borrow from FinTech too. But if you are a manufacturer firm, actually you will not pick a FinTech as your priority. Instead, you might borrow from bank because you might need to borrow larger amount of funds, especially you have fixed assets as a secure or collateral. If you are construction firms, the same meaning, you might need a large amount of funds. So FinTech may not be able to provide that. So bank cover different industry compared to FinTech. The same meaning will be observed like independent finance firms or captive finance firm. So this is a different type of lenders. They may cover different kind of industry too. So here is another question. Can you guys answer that? Why do FinTech lenders focus on like a service or retail industry? Why banks instead focus on like a manufacturing or construction industry? Why they have very obviously separation, market separation. They are not mixed together. If you have some thoughts, can you please answer this? Scan this QR code. multiple choices. Nice. We have only one answer. Nice. Okay. Yeah, you guys have a very good concept and correct direction. Yeah, except fifth. This is incorrect in the fifth option. One, two, three, four are totally correct. So fintech firms focus on this industry because it does not need to fix assets, heavy assets secure, and their data are driven by most AI platform. So you have AI data, you have cash flow, you have short-term working capital, you have others assets. That will be easy for fintech firm to evaluate it and to matching your demanding with the supplier using their platforms. So this is a different type of lending. Uh, so very good. So here we can see the results. So fintech firms compared to bank, you can see that it's a smaller size, right? Most of fintech firms have a significantly lower loan size compared to all other non-bank and bank. It's very small. And the maturity compared to other non-bank and a bank, this is in months, is also very short. So only like a 1.5 years, 15 months. So short-term lending compared to bank and the other non-bank. So they're borrow smaller size of amounts and they have short-term maturity. And another characteristic, we can see what kind of collateral they are using. You might be surprising that fintech firms can use intangible assets. Here, if smaller firms, they only have 38%. The other firms are also very low, but fintech firms is reached to 60%, very high. So intangible assets can be secure as a collateral in fintech firms. So this is a very special. And also usually inventory will not be accepted by non-bank firms or banking. But here we can see fintech firm accept the inventory as a collateral in the highest regions. And of course, they accept equipment, but compared with the other non-bank and the bank, fintech firm has a relatively low equipment ratio. If they can secure, that's the best choice. But fintech firm usually does not require you must have fixed assets as a collateral compared to other lenders. And accept a deposit account. That means if you have cash you can use your deposit account as collateral. So fintech firms have different collateral compared with the other non-banks and the bank. The observation have a lot, a big amount of the data. And here is the county. So did you see the map? So each stop is a county, have a area code. So depending on the bank shares across 50 states and thousands of counties. This is the summary statistic, and it except the control for those financial factors, it also include some macroeconomic factors such as like average wage, labor force, unemployment rate, and many others. So this is another table showing that this paper whether fintech replace or improve the economic factors, and they have some conclusion whether fintech replace bank and does they contribute to the economic factors. They answer these questions later. So here is the table's results. So we can see that counties, if you have higher pre-crisis bank shares, you might experience a large growth in non-bank lending. Also, there have a graphing later. I will show it you. So non-bank market share fill the bank decline gap. And also the real sector results from the previous table here. We can see that both of them seeing that there have no significant change about the macroeconomic data. So credit substitutions doesn't mean new growth is unequal. The other factors is also showing that doesn't change significantly. And here is the empirical model. High bank share before the financial crisis. This is the main factor. And the dependent variable is the change of the market share of loan originated by non-bank. So higher bank share might affect the change of the non-bank market share in loans. So this is the empirical model. See before the crisis how much percentage in your area, your market share, bank market share, and then after that, the change measured by different period, the change of the non-bank market share of loan. So this is the empirical model. This paper employee. And so before the crisis, larger bank shares. After the crisis, larger bank share is associated with it's a decline, right? Yeah, so we can see it's associated with a decline bank lending changing. Larger shares is also associated with negative bank lending changes. And here is a negative signs too. Larger bank share is associated with a declining bank supply. So there's a negative related to each other. Bank lending. Instead, if we are not measured the bank lending, we measure the non-bank, the trend is totally opposite. So here we can see larger bank share is associated with positive non-bank lending and non-bank market share compared with the bank. So these two panels are totally opposite. So after financial crisis, larger bank shares is associated with a positive non-bank market share and a non-bank lending. It's associated with a decline bank lending and bank supply. So here we can see the tables. The graphing have a very obviously trend, but we still need to see the econometric coefficient. Here is the econometric method showing the coefficient for non-bank is significantly and positively to affect the non-bank market share, non-bank lending, right? Including control variable, the result remains, doesn't change, right? And again, if we control for like collateral in the sector factor two digit, the result remained positive related to non-bank market share, non-bank lending. No matter you control for the sector fixed effect or collateral fixed effect here, right? The result remains. So here is another table 8. The authors are interested in knowing after the financial crisis, the whole period, how about the bank share affected the bank-owned financing company market share? And here is an interesting angle that the paper is showing. Higher market share is associated with a positive independent finance market share. That means it switched to independent finance company after that, the shock. And it switched from, because this is a negative signs, right? So higher market share, the loan was shipped from bank-owned financing company to independent financing company. So here is a significantly negatively coefficient the impact on bank-owned financing company market share. So this is another angle that the paper provided. And finally, the paper, sometimes you submit the paper to the editor. The editor will say, but how about the macroeconomic factor? Does they provide any policy implication? So you might need to do more. So how about the employee rate doesn't change, insignificant, right? How about the wages doesn't change significantly? And how about the establishment? It doesn't change significantly. So although some impact emerged and switched the banking market share to non-bank and FinTech market share. However, the real economic factors about the macroeconomy measurement of employment and the wages and establishment doesn't change. Okay, so this is another answers if the editor answer whether this improve the economics as it indicated. It doesn't. So there have some conclusions here. I will go back to here to ask you. So, but I have some comments for this paper too. And the first one, I think you guys may mention may touch this data represented, because the data was using UCC data. It captured only secure and non-real estate loan only. So the data set omitted the unsecured and the real estate based small firms credit. It's around like a 27%. So actually under representative for like a 27%. If the paper can include all of them, that will be much more rich. This is the first one. And the second one is the FinTech classification. The lender only listed like a 20 FinTech lenders classification. And actually, if you Google FinTech firms, a lot different category and different FinTech classification. Many consultant firms also belong to FinTech because they implemented some platforms from lending, from applying, from like a insurance. So if you buy insurance policy, you can use FinTech firms. If you want to lend something, borrow something, you can use FinTech firms. And if you're buying stock, buying bonds, you can use FinTech firm. It is not banking firms. So many activities emerge from FinTech. They are doing the same job as bank, as traditional bank. They have the trading of stock and bonds. They purchase and selling insurance. They have health care. So you can use Oscar. It's a platform to apply the healthy caring. There's a FinTech firm too. So Robinhood, we just talked about the Robinhood, and you can buy stocks and sell stock from there. But beside that, Robinhood provide many other activities. So many FinTech firms actually doing the same job as bank and have a lower requirement and very efficient. You can apply today and you can get the funds tomorrow. If you have no collateral, this is good for everyone to reach FinTech rather than bank. So, but FinTech firms in this paper, they only provide like a 20 category. So they have a lot. So I think the paper can provide a completely much more rich list and using like maybe some of them. But this is another comment for the FinTech because it is a new emergent data set. We should check that in more detail. And endogeneity problem, one group already saying this and mentioned this. I just want to say that there have IV which was lacking. So IV instrumental variables can instrument the market share of bank. So bank market share is not exogenous factors. They are affected by IV. So we should find which IV could affect the bank market share. So this is another suggestions for the paper to add the ivy in testing the endogeneity problem and the soft dots. And another one is the real sector, because they find that it have no impact on real sector, especially employment and the wages and many others. But if the paper can conduct some heterogeneity, yeah, I think the presenter also mentioned this. Heterogeneity, if we control for the different firm size, uh, associated with different industrial interaction, rather than fixed effect, is interaction, they may uh, be able to show the interest in the results, which is totally different. So real sector as a whole is not significantly changed, but in some sectors or in some firms, in some characteristic, if we conduct a heterogeneity analysis, we might be able to find something new. And the last one is at the omitted lender level heterogeneity. So we can do something more about the heterogeneity, about the lenders levels heterogeneity. So this is the minor comments of this paper from me. Finally, we have conclusion. Can each group just mention one point? We have full conclusion. Can each group just mention one point? You can pick one, or you can say something by your own. We have conclusion here. Group number one, saying one point that you learn from this paper. Yeah, so very significantly from non-bank firm, FinTech firms, from the retail and the services firm, which is the largest portion. Okay, nice. And group number two. Yeah, the decline of the bank market share was replaced by the non-bank and FinTech, right? Yeah, during the sample period. Nice. And group number three. Hello, are you there? You can also pick one from here to say something. The last sentence was what? Can you repeat it again? In total. Okay. So future financial regulation, you say, was not focused on bank only because non-bank have their importance to replace the role of bank. So we should also focus on non-bank and make some regulations for them. Is that what you mean? Okay, nice. And group number 4, yeah. But can you say that again? Slow. Yeah. After the crisis, this FinTech lenders provide and fill the gap uh, for the small business, which was ignored by banks. Is that what you mean? Okay, very nice. Okay, so we capture almost the whole pictures, but very diversity. Also, non-bank fill the gap, and fintech belong to non-bank. Actually, they are doing the same job as bank, but bank laws doesn't regulate non-bank, doesn't regulate the fintech. So fintech should be monitored or supervised or regulated by more strictly uh, acts or laws in the future because they are growing bigger and bigger, provide much larger amount of funds. One day they may provide larger amount of funds with longer terms, but without any security. So it might hurt the financial assistance one day. So we should regulate it earlier as we can. And the structure shift by 2016 here, now we can see that non-bank account for 59 of the new small firm loans. Also, if you are a small firm, you have the priority or preference to borrow from fintech rather than bank. So that's a large amount of 59 of small loan belong to fintech. And no real sector effect. They're not influential to the macroeconomy, even though they provide a lot of amounts of funds, but doesn't have any impact uh, on macroeconomic factor, which was also interesting. They only substitute rather than expansion the credit supply. And many other broader implication for you guys to develop in the future. And very nice today to have you all share the papers and the suggestion and the comments together. I think our discussion will end here. Any other questions? If no further questions, let me remind you about our